it never bothered me if people disagreed with what I thought, as long as I felt I knew the facts. I mean, there's a whole bunch of things I don't know a thing about. I just stay away from those. So I stay within what I call my circle of competence. And Tom Watson said it best. He said, I'm no genius, but I'm smart in spots, and I stay around those spots. Well, I try and stay around those spots, and I just don't have a problem if somebody says, you're wrong on something. I go back and look at the facts, and I think that really is much more important, frankly, than having a few points of IQ or having an extra course or two in school or anything of the sort. You need emotional stability.
Hey traders, welcome back to the ComLucro channel. What a great way to begin, with Warren Buffett's timeless reminder about emotional stability and staying within your circle of competence. In trading, that mindset helps you stay rational instead of reacting impulsively. Today, we start a new chapter of our course, Technical Analysis for Day Traders, from Basics to Advanced. Introduction to Technical Analysis. You'll learn what technical analysis is, how it differs from fundamentals, and why it's essential for fast, confident day trading decisions. We'll also look at its origins with pioneers like Charles Dow and Munehisa Hama, and cover key ideas such as market sentiment, price trends, and the power of keeping your approach simple and objective. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Now, let's get started. Let's begin with our topic, Introduction to Technical Analysis. So, what is technical analysis? Technical analysis is the study of past market data, primarily price and volume, to forecast future price movements. Unlike fundamental analysis, which evaluates the intrinsic value of an asset based on financial statements, earnings, and economic factors, technical analysis is rooted in the idea that all relevant information is already reflected in the price. This method focuses on identifying patterns, trends, and signals in the price charts that can indicate future movements. It's like learning to read the market's language, interpreting its signals to make informed trading decisions. In essence, technical analysis is about understanding the psychology of the market, as represented by the collective behavior of traders. By analyzing charts, identifying patterns, and using technical indicators, traders can predict where the market is likely to go next. This approach is especially powerful for day traders who need to make quick decisions based on the immediate price action. Mastering this concept is fundamental to your success as a day trader. Before we dive into the modern tools of technical analysis, let's take a quick look at how it all began. The origins of technical analysis can be traced back to the late 19th and early 20th centuries, primarily through the work of Charles Dow, a journalist and co-founder of the Wall Street Journal. Charles Dow was a pivotal figure in the development of technical analysis, as he sought to create a systematic approach to understanding market behavior. His work culminated in what is now known as the Dow Theory, which laid the groundwork for many of the principles that technical analysis still relies on today. Dow observed that market movements could be categorized into primary, secondary, and minor trends, and that these trends often reflected the overall health of the economy. Dow didn't necessarily invent technical analysis as a standalone concept, but rather establish the framework that would evolve into the complex discipline we know today. His goal was to provide a tool for investors to understand market trends and make informed decisions based on patterns observed in the market data. This was revolutionary because it shifted the focus from the intrinsic value of assets to the analysis of price movements, thus allowing traders to anticipate future price changes. In addition to Dow's contributions, another crucial development in technical analysis was the introduction of candlestick charting, which originated in Japan in the 18th century. The candlestick method was developed by a Japanese rice trader named Munehisa Hama, who is often credited as the father of candlestick charting. His method involved creating charts that visually represented price movements over time, with each candlestick showing the opening, closing, high, and low prices for a specific period. Candlestick charts became a powerful tool for traders because they not only provided a clear visual representation of price movements, but also allowed traders to identify patterns that could predict future price action. These charts eventually made their way to the Western world and became an integral part of technical analysis. While we'll briefly touch on candlestick patterns here, it's important to note that we have an entire chapter dedicated to exploring candlesticks in detail later in the course. Understanding the history and development of these tools is crucial, as it helps to appreciate their value in modern-day trading strategies. Let's take a step back for a moment with Warren Buffett, who brilliantly explains what it means to protect your edge in any competitive environment.
The nature of capitalism is that people want to come in and take your castle. It's perfectly understandable. I mean, if I'm selling television sets or something, there's going to be 10 other people that are going to try and sell a better television set. If I have a restaurant here in Omaha, people are going to try and copy my menu and give more parking and take my chef and so on. So capitalism's all about somebody coming and trying to take the castle. Now, what you need is a castle that has some durable competitive advantage, some castle that has a moat around it. And that moat, one of the best moats in many respects, is to be a low-cost producer. But sometimes the moat is just having more talent. I mean, if you're the heavyweight champion of the world and you keep knocking out people, you've got a competitive advantage as long as you can keep doing it. And it's very profitable if you're the one that happens to be able to do it. If you can turn out great motion pictures, I mean, Steven Spielberg, I mean, he's a fellow to bet on, and it has enormous economic value.
That's the essence of edge, and technical analysis is how we build our own moat as traders. By reading the market, understanding trends, and recognizing repeating patterns, we develop a strategy that keeps us ahead of the competition. Now that we've explored the origins, let's dive into the core principles that form the foundation of technical analysis. Understanding these will give you a solid base to build your trading strategies upon. First and foremost, we have the principle that the market discounts everything. This idea is fundamental to technical analysis and asserts that all available information, whether it's economic data, political events, or even market sentiment, is already factored into the market price. What does this mean for us as traders? It means that rather than getting lost in the endless stream of news and data, we can focus on the price itself. The price action, in essence, tells the full story. By trusting that all factors are reflected in the price, we can zero in on the charts to find trading opportunities. This is where the beauty of technical analysis lies. It simplifies the vast amount of information into what really matters, the price. Moving on, the next principle to consider is that price moves in trends. Trends are the heartbeat of the market, and identifying them is key to successful trading. Whether the market is moving up, down, or sideways, trends provide a roadmap that guides our trading decisions. The idea here is simple. Once a trend is established, it's likely to continue until something significant shifts the market's direction. As traders, our goal is to recognize these trends early and ride them for as long as they last. By doing so, we align ourselves with the market's momentum rather than fighting against it, which is a critical aspect of trading success. Finally, let's discuss the principle that history repeats itself. This concept is based on the observation that human behavior tends to be consistent over time. Because of this, patterns that appeared in the past are likely to emerge again in the future. As technical analysts, we study these historical patterns to predict future market behavior. This is why chart patterns and technical indicators are so valuable. They help us identify when a familiar scenario is unfolding in the market. By recognizing these patterns, we can anticipate how the market might react, giving us an edge in our trading decisions. So, to summarize the principles of technical analysis, believing that the market discounts everything, understanding that prices move in trends, and recognizing that history tends to repeat itself are the pillars that support this approach. These principles not only guide our analysis, but also shape the way we think about and interact with the market. Before we move on, let's hear a powerful reminder from Brian Chesky, co-founder of Airbnb, as he shares a piece of advice Warren Buffett once gave to Jeff Bezos. This insight touches directly on one of the biggest traps traders fall into, the desire to get rich fast. It's a mindset we must actively resist if we want to succeed in the long run.
And I had an opportunity to have lunch with Warren Buffett and Jeff Bezos. And that was like, first of all, thrill of a lifetime, like unbelievable, like two of the greatest minds. And I asked Jeff Bezos a question about Warren Buffett. I said, Jeff, in front of Warren, what's the best advice that Warren Buffett ever gave you? And he said, they've been friends for like 10 years. And he tells me this story. And he says, one day, I call up Warren Buffett and I say, Warren, like, you're like the second richest guy in the world. They're talking, and he's like, your investment thesis is so simple. Like, why isn't everyone just copying you? Mm-hmm. And Warren Buffett replies, he goes, because no one wants to get rich slow. Mm-hmm. And I think there's something to that as well. Like, everyone wants to grow fast. No one wants to grow slow.
That hits home. Because in trading, just like in business and investing, it's tempting to chase shortcuts. But the truth is, lasting success is built slowly with consistency, discipline, and simplicity. Let's shift our focus to a crucial yet often overlooked aspect of technical analysis: simplicity. In a world where information is abundant and complexity can easily overwhelm, simplicity becomes not just a preference, but a necessity. First, let's talk about the importance of avoiding information overload. One of the biggest mistakes many traders make is allowing this overload of information to influence their trading style negatively. It's understandable why this happens. Each market influencer often promotes their own strategy as the best, which can lead to constant second-guessing. When faced with a losing trade or a missed opportunity, it's tempting to switch strategies, thinking that the next one might be the perfect solution. This constant shift not only disrupts discipline, but also undermines the effectiveness of your trade. What many influencers often overlook is a fundamental truth. Technical analysis isn't about precision. It's about probabilities. No strategy can guarantee perfect outcomes because markets are, by nature, unpredictable. The real edge comes from consistency, not perfection. That's why your focus should be on finding a trading setup that fits your style, defining at least 3 clear entry rules, and then rigorously backtesting each one. Through backtesting, you gain insight into how your strategies perform over time, without risking real capital. This process not only sharpens your approach, but also builds the confidence and discipline needed to succeed in the long run. So, as you progress through this course, keep in mind that simplicity is your ally. By focusing on what really matters and avoiding unnecessary complexity, you'll be better positioned to navigate the markets with confidence and clarity. Now that we've covered the foundational principles of technical analysis, it's time to explore the essential tools that will help you put these principles into practice. As a beginner, having the right tools at your disposal is crucial to your success. First, let's start with the basics: charts and indicators. While there are numerous indicators available, such as the RSI, MACD, and many others, as a beginner, it's important to focus on a few foundational tools that are integral to classic technical analysis. These core tools include candlestick charts, volume, and the 20, 50, and 200 period moving averages. Candlestick charts provide a wealth of information in a visually intuitive format, allowing you to see not only the price direction, but also the strength of that movement. The candlestick pattern analysis is rooted in historical data and has been extensively discussed in classic works like Steve Nison's Japanese candlestick charting techniques. Understanding candlesticks is crucial because they form the basis of price action analysis, helping traders identify market sentiment and potential reversals. Volume is another key indicator to focus on. Volume measures the number of shares or contracts traded in a security and is used to confirm the strength of a price move. A move with high volume is more likely to be sustained than one with low volume. This is why authors like Richard Wyckoff emphasize the importance of volume in his studies on market behavior. By analyzing volume alongside price action, you gain deeper insights into the market's dynamics. Moving averages are perhaps the most widely used indicators in technical analysis due to their ability to smooth out price data and reveal the underlying trend. Let's break down the significance of the 3 most critical moving averages: the 20, 50, and 200 period moving averages, and how each plays a distinct role in your analysis. Starting with the 20 period moving average. This is your go-to for tracking short-term trends. By smoothing out daily price fluctuations, it provides a clearer picture of the immediate trend, helping you to identify potential entry and exit points for quicker trades. Next, the 50-period moving average comes into play for identifying intermediate trends. This moving average is often used as a reference point by traders to gauge the overall market direction. When the price crosses above or below the 50-period average, it can signal a potential shift in market momentum. Finally, we have the 200-period moving average, which serves as the long-term trend indicator. This is a critical tool for both traders and investors, as it often acts as a significant support or resistance level. Observing how the price interacts with the 200-period average can give you valuable insights into the broader trend direction, and whether the market is in a bullish or bearish phase. These moving averages are not chosen arbitrarily. They are staples of classic technical analysis, discussed in detail in books like Technical Analysis of the Financial Markets by John Murphy. The 20, 50, and 200-period moving averages are preferred because they help traders see the big picture, while remaining responsive to shorter-term changes in market conditions. Focusing on these averages helps you avoid the noise of shorter time frames and allows for a more disciplined trading approach. By concentrating on these fundamental tools, candlesticks, volume, and the 20, 50, and 200-period moving averages, you align yourself with the principles of classic technical analysis and set a strong foundation for your trading journey. Next, let's talk about where to find and how to use these essential tools. While there are numerous platforms available for technical analysis, one stands out for both its accessibility and popularity: TradingView. TradingView is widely regarded as the best platform for beginners, and for good reason. It offers a user-friendly interface combined with powerful charting tools and indicators that cater to traders of all levels. One of the key advantages of TradingView is its accessibility. You can start using it for free, which includes access to basic features that are more than sufficient for beginners. This makes it an excellent starting point without requiring any upfront investment. Additionally, TradingView allows you to create custom charts, share your ideas with a community of traders, and even backtest your strategies using historical data, all within the same platform. However, it's essential to not only choose the right platform, but also to truly understand how to use it effectively. Think of it like getting your driver's license. Knowing how to drive is crucial, but if you don't understand how your car works, the car you'll be driving every day, you'll run into problems sooner or later. Similarly, in trading, it's not enough to know the basics of technical analysis. You need to be fully familiar with the platform you choose to operate on. This knowledge will allow you to execute trades efficiently, make quick adjustments, and fully leverage the tools at your disposal. While there are other platforms out there, TradingView's combination of ease of use, comprehensive features, and a free tier make it the ideal choice for those just starting their journey into technical analysis. By familiarizing yourself with TradingView, you'll be well equipped to begin analyzing the markets effectively and developing your trading strategies. Remember, the key is to start simple, focusing on mastering a few tools within TradingView before gradually expanding your toolkit as you gain experience. Now that we've covered the foundational aspects of technical analysis, it's important to shift our focus to how these principles apply specifically to day traders. Day trading is a fast-paced, high-intensity style of trading that demands quick decision-making and precise execution. Let's explore why these skills are critical and how they shape the approach of day traders. In day trading, speed is everything. The ability to make quick, informed decisions can be the difference between a profitable trade and a missed opportunity. This is where technical analysis becomes indispensable. By focusing on price action, patterns, and key technical indicators, day traders can react swiftly to market movements. The markets can change in an instant, and having a solid grasp of technical analysis allows you to make split-second decisions with confidence. Whether it's identifying a breakout or spotting a reversal, the quicker you can analyze the situation and execute your trade, the better your chances of success. Unlike swing traders or investors who might focus on daily, weekly, or even monthly charts, day traders operate on much shorter time frames. The most commonly used time frames in day trading are the 1-minute, 5-minute, and 15-minute charts. These shorter time frames provide a detailed view of the market's immediate movements, allowing day traders to capitalize on small price fluctuations throughout the day. This focus on short time frames requires a different set of strategies compared to those used in longer-term trading. Day traders need to employ targeted strategies that are specifically designed to work in these rapid environments. Strategies such as scalping, where traders aim to profit from small price changes, or momentum trading, where traders capitalize on strong price movements, are popular among day traders. These strategies rely heavily on the ability to quickly analyze technical indicators and market conditions. It's important to understand that day trading is not about predicting long-term trends. It's about reacting to what's happening in the market right now. The precision and speed required in this style of trading make technical analysis not just a tool, but a necessity. A common mistake that leads to disastrous results and significant financial losses is turning a short-term trade into a long-term position. For example, if you're using a 60-minute chart to analyze the overall trend and a 5-minute chart for your entries, under no circumstances should you change your approach because you're unwilling to accept a stop loss. Shifting your analysis to a 4-hour chart and your entries to a 15-minute chart in an attempt to avoid a loss is a recipe for disaster. This rule applies to any time frame you choose to operate in. Another critical and unforgivable mistake is attempting to average down on a losing trade, commonly known as doing a cost average. There are specific setups designed for cost averaging, and you should study and thoroughly test them if you plan to use this strategy. But never ever change a strategy that isn't based on cost averaging into one that is. The biggest trap with averaging down is that most of the time you may recover the trade, but without realizing it, you're drastically increasing the risk and lowering the reward ratio of your trade. A single unexpected event, like a gap or a significant news release, can financially devastate you. Even worse, if the market continues in its trend direction without reversal, it could lead to a loss so severe that it becomes irreversible. I'll say it again so it sticks. Never, ever turn a strategy that isn't designed for cost averaging into one that is. Making this mistake could very well be the worst error of your financial life. To close today's lesson, let's hear from Dr. Brett Steenbarger, one of the leading voices in trading psychology. His work has helped thousands of traders identify and correct emotional patterns that silently sabotage performance. In this clip, he breaks down two of the most common behavioral traps: under control and over control.
What are the situations that typically set you off? In trading, most of the problem behaviors are problems as the result of under control or over control. Under controlled behavior would be trading impulsively. I suddenly forget about my position limits and I'm trading much larger size than I should be. I'm suddenly not honoring my stops. I know I shouldn't be adding to a losing position, but I keep finding myself doing that. That's an under-controlled behavior. The opposite would be an over-controlled behavior. I'm so anxious I can't pull the trigger and make the trade. My system told me that I was supposed to go long in the morning, and I just sat there and watched the whole damn thing go up and up and up and up. That's an over-controlled behavior.
That's why emotional discipline is just as vital as a solid trading strategy. Knowing when to act and when to hold back is what sets consistent traders apart. Today, we covered the core principles of technical analysis, timeless ideas that help you avoid common pitfalls and trade with greater clarity. At its core, technical analysis isn't just about charts or indicators, it's a mindset. It's about understanding that the market reflects everything, that trends matter, and that history often repeats itself. Combine that mindset with simplicity, the right tools, and discipline, and you have the foundation for. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.